All right, let's talk about DigitalOcean's massive Q3 earnings call. We're going to break down exactly how one single report completely changed the narrative for this company and sent a huge signal to the market. Let's dive right in. So, the first thing you need to see is this number. The market's reaction was immediate and it was huge. The stock just exploded, closing up 18% on the day. A move like that on an earnings report isn't just noise, it's a major statement.
And that immediately brings us to the big question, right? What in the world did DigitalOcean report that made investors reevaluate the company so dramatically, basically overnight?
Well, the story really begins with the headline numbers. And this wasn't some tiny squeak-by-the-numbers beat. Nope, this was a clear, decisive outperformance that set the tone for everything else.
The company just sailed past Wall Street's expectations. Revenue came in at $230 million. That's almost $4 million ahead of what analysts were looking for. And on the bottom line, earnings per share landed at 54 cents, a solid 5-cent beat. So right out of the gate, this set a really bullish tone for the whole call.
But here's the thing. A top and bottom line beat is only part of the story. The real reason for that 18% pop was the story behind the numbers, the fundamental shift in the business. And it all centers around one thing: artificial intelligence.
The CEO, Paddy Srinivasan, he really framed it perfectly. He's positioning DigitalOcean as a unified agentic cloud, which is basically a fancy way of saying it's a platform built specifically for creating and scaling AI applications. And this isn't just some marketing spin, because the data absolutely proves that it's working. And here is the first piece of hard evidence for you. The company added $44 million in new annual recurring revenue. Now, that's not just a big number. It is the highest in the company's entire history. That's what you call some serious acceleration.
And what's really crucial here is where this growth is coming from. It's coming from their biggest and most valuable customers. Revenue from clients spending over $100,000 a year, that grew 41%. Even better, revenue from their $1 million-plus accounts shot up an explosive 72% year over year. This shows they're not just getting customers, they're getting big ones and scaling right along with them.
And the engine behind all that scaling? It's crystal clear. For the fifth consecutive quarter, revenue from AI workloads more than doubled. You see, this isn't a one-time blip. It is a sustained, accelerating trend that basically validates their entire agentic cloud strategy.
So how does all this great performance translate into the future? I mean, strong results are one thing, but it was really management's guidance that got the market's imagination fired up. They're making a pretty big bet on this momentum.
And this slide just illustrates the strategic pivot perfectly. On one hand, management raised their full-year revenue guidance, a huge show of confidence. But at the same time, they guided Q4 earnings per share below what analysts were expecting, and that created a bit of a puzzle for investors to solve.
So what gives? Well, the key here is that this wasn't a sign of weakness at all. It was a strategic choice. Management flat out said that demand, especially for AI, is just overwhelming their current supply. So they are deliberately choosing to invest heavily right now in new data centers and more GPUs to capture all this demand. In other words, they're trading a little short-term profit for a whole lot of long-term growth.
And here's the payoff for making that investment. Because of this super strong demand and their plan to meet it, management now feels confident enough to pull their long-term growth target forward by a full year. They were targeting 18 to 20% growth by 2027. Now, they expect to hit it in 2026. That is a massive signal of confidence.
So, you've got a strong beat, you've got a powerful AI growth story, and a confident plan to invest for even faster growth. When you put all those pieces together, it basically forced Wall Street to completely reevaluate the stock.
The reaction from analysts was, well, swift and significant. Morgan Stanley raised their price target to $56. UBS bumped theirs to $48. But the really big one was Bank of America. They issued a rare double upgrade, jumping the stock all the way from underperform to buy with a $60 price target. That's a huge vote of confidence.
And it wasn't just the analysts either. Trading volume on earnings day was 4 to 5 times the daily average. Let me tell you, that's not just retail speculation. That was a massive influx of institutional money, as the big funds all piled in to buy this new, accelerated growth story.
So, let's put all the pieces together. What does this all mean for the next quarter and beyond? Well, here is our call on what to expect.
We're going to break our prediction down into 3 clear parts. First, what to expect from the Q4 results themselves. Second, how we see the stock behaving. And third, our final official rating.
Okay, for Q4, we fully expect another revenue beat. The momentum from AI is just too strong. The key thing for investors to watch is going to be execution, making sure that new data center capacity comes online smoothly. As for the stock, look, a little consolidation after an 18% jump is totally healthy and expected. But after that, we see a steady climb as the market really starts to digest and price in that accelerated 2026 growth target.
And that brings us to our final rating. We are initiating DigitalOcean with an outperform rating and a price target of $58. This company has successfully pivoted from just being a niche cloud player to becoming a real high-growth AI infrastructure story. That kind of transformation, well, it warrants a higher valuation, and we believe the market is still in the early innings of recognizing it.
This is not financial advice.